if we look, who's the low-cost player, right? Well, technically Allegiant, but shortly after that you get to Spirit, and who's the high-cost player who's in a fight with the low-cost player, second most low-cost player, is in fact United Airlines. If you look at the history, Spirit's been taking share, UAL has been ceding it. Very often we've called United the provider of capacity discipline in the industry, and the data bear that out. If we look at what is really going on, what's the main story in the industry, slide 9, you'll see that the ULCCs just take share, right? This has actually been a pretty big trend, and mostly an accelerating trend in the marketplace. These guys are increasingly relevant. Each one is kind of small. In total, if you define it more broadly to include just sort of even the middling players, the major trend is that the legacy carriers have been losing share. Slide 10, you can see Spirit specifically has been a major driver of those share gains. Like, can you identify the trend here? Yes, like these guys have been winning. The model is certainly working in terms of growing their presence in the U.S. market and the global market to a lesser extent, but certainly domestic. And realistically, when you grow like this and you whack into some competitors, you're going to attract some unwanted competitive responses, and that seems to be what's happened here. What's important is they've grown that share in that exponential way on slide 11 while also expanding margins, right? So that is a good model, right? Like if you can take share, grow quickly, and expand margins, it suggests that you have something figured out. It's been pretty linear. It's also been replicated, as we'll see, at other ultra low-cost carriers, so it's not necessarily unique to Spirit. It's, I think, a function of the model and market dynamics. And hey, it's a fairly commoditized industry. You're the low-cost player. Obviously, you're probably going to take share. Slide 12, we can see the other side of that share gain. This is merger adjusted, so it's a continuous. This is as if all the mergers had happened at the beginning of the chart. We'll look at the other way of seeing it in a couple slides. But realistically, these legacy players have consistently lost share, right? And I think what we'll show in a minute is that it's really a question of the two highest cost players losing share. So Delta and Southwest haven't really lost share the way American and United have. But that is, I think, the dominant trend in the industry. Slide 13, you can see more specifically American and United have a problem, right? Like they're basically ceding share to keep pricing high, right? So they could obviously lower prices, keep share, keep prices where they are, and lose share. If you make that a rolling top 4 competitor on slide 14, this is a pretty interesting chart, longer term. You can see the mergers as they happen, and as soon as the merger happens, the legacy players go back to actually losing market share. So this is the dynamic that the legacy carriers are responding to, right? So eventually, for somebody like United, if you lose too much market share, your frequent flyer program has limited value. You devalue your loyalty programs. Why would a business traveler want to book on United if they can't fly where they want to fly for their vacation, or they don't have as convenient of a schedule or whatever it is? So they're not there yet, but if they continue to lose share, as the legacy players have, it becomes a problem for them.